Good afternoon, ladies and gentlemen. The Monetary Policy Committee met on 21st and on the 22nd of March 2016 amid uncertain global economic prospects and continuing challenges in the domestic economy. In attendance were 8 out of 12 members. The committee appraised the international and domestic economic and financial environment in the first 2 months of 2016, as well as the output for the rest of the year. The committee noted with concern the further decline in global output at the end of 2015, which grew at 2.3% year-on-year in the fourth quarter of 2015. Its slowest in 3 years, representing a 0.3 percentage points decline compared with 2.6% in the third quarter. This deceleration stemmed from the continuous slowdown of growth in the emerging market economies, worsened by deteriorating conditions in the euro area and China, as well as key emerging market economies. Other factors include sustained pressure in global financial markets arising from the United States monetary policy normalization, depressed global oil market, and persistently weakened global aggressive demand. The slowdown in growth in the United States to 1% in fourth quarter from 2% in third quarter was attributed to slowdown in private consumption expenditure and non-residential fixed investments. In Japan, output declined by 1.4 percentage points in the fourth quarter of 2015, in contrast to the 1.3% growth recorded during the third quarter. The Bank of Japan's monthly assets purchase program of 6.7 trillion yen remains substantially suboptimal as the economy continues to lurch between contraction and expansion, with the adoption of a negative interest rate policy in January 2016. In the euro area, the gross domestic product grew by 1.5% in the fourth quarter of 2015 and projected to grow at 1.7% in 2016. The European Central Bank, at its meeting on 10th of March 2016, eased monetary policy by further reducing its refinancing rate to 0% and deposit rates to 0.4%. The bank also expanded its monetary assets purchase program from 60 billion euro to 80 billion euro to further stimulate output growth and move inflation towards its long-term objective of 2%. On the other hand, the Bank of England sustained its stock of assets purchase, financed through the issuance of reserves at £375 billion, while retaining its policy rate at 0.5%. The Bank of England further committed to investing £8.5 billion of cash flows associated with redemption of the January 2016 government securities held in the asset purchase facility, with a commitment to bringing inflation closer to 2% target, reduce unemployment, and promote growth. Uncertainties and geopolitical tensions in the Middle East, including a negotiated ceasefire agreement in Syria and Iran's re-entry into mainstream international oil market, may have further redefined conditions in the oil market. The market witnessed some uptick in prices following the resolve of the Organization of Petroleum Exporting Countries and some non-OPEC members to pursue a higher anchor price, coupled with smaller than anticipated build-up in stocks at the Cushing, Oklahoma delivery hub for United States crude futures. The emerging markets and developing economies were forecast to grow at 4.3% in 2016, an improvement over the 4% recorded in 2015. However, external and domestic challenges have persisted, stemming from low commodity prices, troubled financial markets, and tepid global demand, policy uncertainty, as well as continuously feeble growth in the global trade. In addition, weaknesses in major emerging market economies, diminished capital inflows, rising borrowing costs, and geopolitical factors have been identified as possible deterrents to growth in the emerging market developing economies. In the environment of suppressed inflation, slow growth, weak global demand, and volatile financial market, the stance of monetary policy in the advanced economies is expected to remain accommodative in 2016, while in the EMDCs, it is expected to be underpinned by currency adjustments. The bank had adopted accommodative monetary policy since July 2015 in the hope of addressing growth concerns in the economy, effectively freeing up more funds for deposit money banks by lowering both the cash reserve ratio and the monetary policy rate, with excess liquidity arising from the lower CRR warehoused at the Central Bank of Nigeria. Deposit money banks were to assess these funds by submitting verifiable investment proposals in the real sector of the economy. The funds have not impacted the market yet because the bank was still processing some of the proposals submitted by deposit money banks. In the first episode of easing, which resulted in injecting liquidity into the banking system, deposit money banks did not grant credits as envisaged. Moreover, the delay in passage of the 2016 budget has further accentuated the difficult financial condition of economic agents as output continues to decline due to low investment arising from weak demand. The cautious approach to lending by the banking system, underpinned by a strict regulatory regime, conditioned by the Basel Committee in the post-global financial crisis era, has further alienated investors from access to credit as banks prefer to build liquidity profiles in anticipation of government borrowings. In light of this development, domestic output growth in 2015 remained subdued as reported by the National Bureau of Statistics. Real GDP grew by 2.11% in the last quarter of 2015, more than half a percentage point lower than the 2.84 percentage points recorded in the third quarter and 3.83 percentage points in the corresponding period of 2014. Overall, growth in 2015 was estimated at 2.79% compared to 6.2% in 2014. The major impetus for growth continued to come from the non-oil sector, which grew by 3.14% during the third quarter of 2015, compared to 3.05% in the preceding quarter. The key drivers of growth in the non-oil sectors were services, agriculture, and trade, contributing 1.23, 0.83, and 0.76 percentage points respectively. The committee noted the sluggish growth in output was directly attributable to certain fiscal uncertainties, which inadvertently hampered the movement of labor and goods, fuel scarcity, increased energy tariffs, foreign exchange scarcity, as well as slow growth in credit to private sector in preference to higher credit growth to the public sector. The committee noted that many of these factors were outside the control of monetary policy, and given this limitation, in the absence of complementary fiscal and structural policies, the only option was to continue with the existing measures. The Monetary Policy Committee believes that complementary fiscal and structural policies are essential for reinvigorating growth. Committee noted the increase in year-on-year headline inflation to 11.38% in February 2016 from 9.62% in January and 9.55% in December of 2015. The increase in headline inflation in February reflected increases in both food and core components of inflation. Core inflation rose sharply for the first time to 11% from 8.8% in January after a lull of 3 consecutive months at 8.7% through December 2015. Food inflation also inched up to 11.35% from 10.64% in January and 10.59% in December 2015. The rising inflationary pressures was traced to the lingering scarcity of refined petroleum products, exchange pass-through from the imported goods, seasonal factors, and increased electricity tariff. The committee noted that the factors responsible for rising inflation were more structural in nature than monetary, but reaffirmed its commitment to monitor the development closely and to work with the relevant authorities to address the underlying drivers of the upward price movement. Broad money supply grew by 2.29% in February 2016, in contrast to 1.69% and 0.25% in January 2016 and February 2015, respectively. When analyzed, M2 grew by 13.74% in February 2016 against the provisional growth benchmark of 15.24% for 2016. Net domestic credit grew by 3.71% in the same period, analyzed at 22.26%. At this rate, the growth rate of net domestic credit was below the provisional benchmark of 29.3% for 2016. Credit to the private sector grew by 1.45% in February 2016, which analyzed to a growth of 8.7%, below the benchmark growth of 13.28%. The committee noted with concern the dismal performance of growth in credit to the private sector, noting that even at that, credit went primarily to low employment elasticity sectors of the economy. This had a significant negative impact on output growth. Money market interest rates reflected the liquidity situation in the banking system. Average interbank call and OBB rates, which stood at 0.5 and 2.77% on January 25, 2016, closed at 4% and 5% respectively on March 9, 2016. Between January 25th and end of February 2015, interbank call and OBB rates averaged 1.43 and 2.68% respectively. This was traced to liquidity surfeit in the banking system. The deposit money banks were, however, reluctant to grant new credit because of rising non-performing loans, amongst other reasons, which, however, were mainly in the oil sector. The committee also noted a significant improvement in the equities segment of the capital market during the review period. The oil share index rose by 8.1% from 23,916.15 on January 29, 2016 to 25,853.58 on March 14, 2016. Similarly, market capitalization rose by 8.02% from 8.23 trillion to 8.9 trillion during the same period. However, relative to end of December 2015, the indices declined by 9.73% and 9.74% respectively. The external sector developments. The average Naira exchange rate remained stable at the interbank segment of the foreign exchange market during the period under review. The exchange rate at the interbank market opened at 197 Naira to the dollar and closed at the same, with a daily average of 196.99% Naira to the dollar between January 25 and March 14, 2016. The committee reiterated its commitment to maintaining a stable Naira exchange rate. The committee took note of the level of activity in the autonomous foreign exchange market, as well as the rising demand in the interbank market, but observed that the data on demand for foreign exchange being overshadowed by speculative demand. However, the committee charged the bank to speed up reforms of the foreign exchange market to improve certainty and eliminate noise and opportunities for arbitrage. The committee noted the weakening macroeconomic environment reflected particularly in foreign exchange shortages, slowing GDP growth rates and rising inflation. Overall, economic growth slowed significantly in 2015, particularly during the fourth quarter. Apparently, the conditions responsible for the slowdown, uncertainty around fiscal policy, adverse external environment, security challenges in some parts of the country, affecting production and distribution of agricultural produce, low electricity supply, fuel shortages, and sluggish growth in credit to the private sector have continued in the first quarter of 2016. On the monetary side, Contrary to the notion of liquidity overhang in the financial system, the wider economy appears starved of the needed liquidity to spur growth and employment. Recent performance of the monetary aggregates lends credence to this fact. With the exception of credit to government, growth in all the monetary aggregates remained largely below the indicative benchmarks, yet headline inflation spiked to 11.38% in February 2016, substantially breaching the policy reference band of 6 to 9%. Apart from liquidity, the increase in inflation was driven by structural factors such as fuel scarcity, increased electricity tariff, persistent insecurity, SNJ pass-through, and seasonality of the agricultural produce. The conflicting signals from slowing growth and rise in inflation present a difficult policy challenge. Though mindful of the limitations of monetary policy in influencing the drivers of the current price spiral, the committee stressed the need to urgently address the key sources of pressures. In this regard, the committee reaffirmed its commitment to closely monitoring the developments while encouraging relevant authorities to address the structural bottlenecks. From monetary data, the committee noted that excess liquidity in the banking system was contributing to the current pressure in the foreign exchange market, with a strong pass-through to consumer prices. The committee further noted that previous efforts to reflect the economy in order to spur growth did not elicit the required response from developed money banks, hence the suffering of liquidity in the interbank market. Obviously, the attendant low rates at that market have not transmitted to the term structure of interest rates. Concerned about the need for low interest rates to support growth and employment, the committee urged the central bank to explore innovative ways of ensuring the unhindered flow of credit at low cost to key growth sectors, even as monetary policy has to, under the circumstance, address the liquidity surfeit in the banking system as well as the pressure on exchange rate and consumer prices. The committee hopes that fiscal and other social policies will soon be deployed to strengthen the overall response of macroeconomic policy to the shocks. The committee was also concerned with the headline inflation at 11.38%, noting that the policy rate had become negative in real terms. This development has potential of keeping both foreign and domestic investments on hold. As part of measures to address the supply constraints in the foreign exchange market, yields on domestic instruments have to be competitive to attract the much needed foreign inflows. On the administrative side, this will have to be complemented by a comprehensive reform of the foreign exchange market, which is currently being undertaken. For the avoidance of doubt, the bank will continue to allow domiciliary account holders unfettered access to their funds, to the funds in their accounts. The committee also urged speedy passage of the 2016 budget in order to halt the depressing effect of the uncertainty that engulfs the waiting period, hoping that the implementation of the budget would go a long way in boosting business confidence and reinvigorating the financial markets. In the circumstance, the committee urged the bank to continue to upscale its surveillance of the financial system with the aim of promptly detecting and managing vulnerabilities to ensure sustained stability. Finally, the committee remains committed to price stability across the range of consumer prices, exchange rate and interest rate, which is fundamental to reviving economic growth and employment generation. In the meantime, the bank will continue to leverage its development finance policy to support critical sectors of the Nigerian economy. The MPC also stressed the need to sustain, deepen, and speed up reforms designed to ensure focused coordination of monetary and fiscal policies. The committee's decision. The committee, in its assessment of relevant internal and external indices, came to the conclusion that the balance of risks is tilted against price stability. The MPC therefore voted to tighten the stance of monetary policy. One member voted to retain CRR at 20%, while another member voted to retain the current width of the asymmetric corridor. In summary, the MPC voted to 1. Raise MPR by 100 basis points from 11% to 12%. 2. Raise the CRR by 250 basis points from 20% to 22.5%. 3. Retain liquidity ratio at 30%. And 4. Narrow the asymmetric corridor from plus 200 and minus 700 basis points to plus 200 and 5 minus 500 basis points. Thank you for listening.
Distinguished ladies and gentlemen, we have heard the communique of the 248th Monetary Policy Committee meeting, and I want to appeal that as decent as we have been in this gathering, that now that we are going into the question time, that we please obey and comply with our house rules here, that all questions and comments should be limited to the subject matter reflected in the communique. I would be grateful if we abide by that. Thank you very much. Just come up, tell us your name and your organization, and then ask your question. Yes.
My name is Emefiele. I won't find it. If I heard you well, you said the committee had urged the bank to eliminate the noise around the foreign exchange demand. If I heard you well, I don't understand.
Yes.
Senior Governor, sir. My name is Cliff Ayose of NTA News. So you did say that the fiscal and monetary policies ought to be complementary in ensuring that we have reinvigorating economic growth. Since the CBN is working hard on this end, I believe on the other hand that might be doing some work. What kind of synergy are you enjoying with those on the other divide, the fiscal side, meeting with the Minister of Finance to weigh options on how to reinvigorate the economy? That's on one side. On the other side, sir, we're hearing from the, will I call it rumor mill, that the Central Bank of Nigeria intends to or plans to convert the over $20 billion in domiciliary account into Naira. How true is this? Thank you.
Good afternoon, sir. My name is Ugo from Premium Times. So in the last MPC meeting, you spoke about the fact that the CBN is considering streamlining FX management guidelines. And you not really mentioned, in that meeting you said that they are not ready yet. And this one is like, you didn't mention anything about it. So I don't know whether you are going to talk about what you're doing about it.
Good afternoon, sir. My name is Communique, I write for Nigerian Channel. And the course of your reading in the course of your when you made mention that the Deposit Bank is refusing to grant new credit because of the non-performing loans. I'd like to know what is the rate of the non-performing loans in the system.
Thank you. I think no one can take these questions. Apparently, the communique is very clear. Mr. Gomez.
Well, NTA spoke about the synergy with the fiscal authority. Let me say yes, we've been meeting and we've been talking regarding the direction of the economy, regrettably about even the challenges that face us at this time, and realizing fully well that this challenge is just not peculiar to Nigeria, it's a challenge that currently confronts practically all economies in the world, whether you're a commodity exporting country or not. And we've been discussing, and I am very sure that in due course, some deliberations at the economic team meeting, which will be unfolded by way of a document, will in due course be released to the public. Comments about $20 billion in domiciliary account. Yes, the truth is that yes, we have customers that have about $20 billion in domiciliary account. But I think I need to seize this opportunity to say that those funds are not idle, like has been wrongly quoted by one of my colleagues have been quoted. I'll use the word wrongly, because those funds are not idle. Those funds on the balance sheet, they are funding certain assets at the other side of the balance sheet. So the 20 billion is a liability in the balance sheet, and it is funding assets at the other side of the balance sheet. So there's nothing like those funds being idle. Okay? And of course, I need to reiterate the fact that there is no intention, there will never be that intention. It is not within our view, our sight at all, to begin to talk about converting people's domiciliary accounts. And I would wish that this should be taken very seriously. We try what we're trying as much as possible is to make the market open as much as possible and not create further tightening situations that will create problems for the economy. Streamlining FX management guidelines. Yes, it is true that we have a mandate, and I said so at the last meeting. Basically, I think I must confess that the issues here has to do with improving the supply of foreign exchange in the market. I'm aware, and I'm sure some of us know, that the price of crude is strengthening gradually, albeit not as encouraging as we think it should be. We are just hoping that with time there will be improvement in supply. And the Central Bank of Nigeria is, we've been holding various consultations and discussing with various interest and stakeholder groups to see into how we can improve on the supply. As soon as we are able to achieve, I would say, tangible success in this direction, we will certainly unfold this for Nigerians to know about it. I apologize that it's taking time, but I'm sure in the course of time we'll come up with something that is acceptable to everybody. Deposit money banks refusing to grant loans due to NPL, due to high rising NPLs. It is true that as a result of challenges facing the economy, of course, when there are issues like this, naturally what you find is that there will be unfortunately cases of people not being able to service their loans the way they are expected to, and so there's been some rise in NPLs. But we have a threshold of maximum of 5%, and we've tried as much as possible to keep it at about between 3 to 3.5%, but unfortunately this has risen close to the upper band of about 5%. That is currently being reviewed by the Committee of Governors, and discussions will be held with the banks that are concerned to begin to look at the type of loans and credits that have been granted and what measures will need to be taken by the banks, by deposit money banks, to ensure that the NPL is within the range that is expected. Lastly, Banker talked about the noise around the FX. I think there have been a couple of issues raised regarding the basis of allocation of foreign exchange. Unfortunately, as a result of the lack or shortage in FX supply, naturally we have to adopt a situation where people will not be able to get the size and quantum of FX that they expect to get. And the more reason why we have also said there is a need for us to continuously and increasingly explore opportunities that where we can find our raw materials locally, let's explore opportunities for sourcing those raw materials locally rather than going for import options. That is the reason we have tried as much as possible to appeal to all of us to see to it that items or goods that can be produced in Nigeria, that we please seek ways to produce them locally and consume them locally, rather than seeking foreign exchange seeking foreign exchange to import these items. The items are very clear to all of us. We know what these items are. And all we can continue to do is to appeal to all of us, to those who are keen or who are desirous of importing goods that we can produce within the country, to please try and look inwards. By looking inwards, what that does is that it reduces the demand for foreign exchange. As it reduces the demand for foreign exchange, those who are importing items that we cannot produce in the country now have the opportunity of getting more foreign exchange to import the items. There's a lot of issues about it, and what I have always said is that both the banks and the central bank will all have to come transparently about the basis of allotment, and we've tried through publications to see to it that this is done. The central bank and the banks have held meetings where we've discussed the basis. And we got to a point where we insisted that every customer must get pro rata of what they bid for. But of course, at that meeting, the banks themselves appeal for certain discretion as to the basis that can be used to allocate foreign exchange. We saw to their need, because if, for instance, somebody asks for foreign exchange to import 1 million, an item for 1 million, and maybe he gets only 100,000, it means he will have to wait for 10 bids to be able to get 1 million to import that item. We thought that it would have been necessary to say, look, this bank just allocate pro rata 10% or 5%, like case maybe, or 20% to every importer. But that will not achieve the purpose, because you'll find a situation where so many people will have to wait before LCs are opened. So we granted the bank the dispensation to use their discretion as to how they allocate foreign exchange to their customers. I thought it's important to address this because there's been a lot of issues about the allocation, but this is what we have done. We know, and we know that there are a lot of issues associated with the shortage of supply. We will try as much as possible to see what we can do to improve supply, but at least more importantly, this is the time, I repeat, those of our customers, or those bank customers that know that the importing items that can be produced within the country, would like to appeal to them to please look inwards, because that's the only way, that's one way that we can diversify the economy away from relying entirely on oil. I thank you all.
It remains for me to thank every one of us for being so kind and so orderly. See you in 2 months' time. Thank you.